Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's get across what happened overnight. Global equities falling as investors rotated out of tech while precious metal prices rallied. Now on Wall Street, investor concerns about AI creating more competition for software makers led to a sell-off in those stocks, dragging the Nasdaq in particular lower. And a catalyst for the fears was Anthropic's launch of a legal tool for its Claude AI chatbot. Nvidia and Microsoft shares fell heavily, while Alphabet, which reports earnings tomorrow morning, fell along with Amazon ahead of its report the following day. Among those stocks hammered were software as a service companies, including Salesforce, Adobe, Synopsys, and Atlassian, while Intuit slumped, along with Expedia losing more than 15%. AI data firm Palantir bucked the trend. It did rise following strong quarterly results. Advanced Micro Devices fell ahead of its quarterly report after the bell, and PayPal dropped precipitously after it forecast 2026 profit below estimates. Healthcare stocks also coming under pressure after Wegovy maker Novo Nordisk warned that it expected a steep decline in annual sales, with Eli Lilly and other obesity drug makers also under selling pressure. And Pfizer shares fell despite posting fourth quarter profit above estimates, while Merck rose after its positive quarterly results. Walmart has become the first retailer to hit $1 trillion in market valuation, with its shares rising. Disney named theme parks head Josh D'Amaro as chief executive. And turning to what we're seeing on the macro level, the US House of Representatives has narrowly approved a bipartisan deal that would end a partial US government shutdown, in the Senate to President Trump to sign into law. Meanwhile, on the geopolitical front, the US military has shot down an Iranian drone that it said had aggressively approached its aircraft carrier in the Arabian Sea. The incident comes as diplomats seek to arrange nuclear talks between Iran and the United States. Well, Federal Reserve Governor Stephen Miron says the current state of US monetary policy is too tight for the economy, saying I'm probably looking for a little bit more than a point of interest rate cuts over the course of the year. Well, incoming Federal Reserve Chair Kevin Warsh is expected to press for rate cuts while shrinking the US central bank's balance sheet. US Treasury yields have risen as traders contemplate a shift in Fed policy. The yield on the 2-year note rising to 3.58%, the 10-year is around 4.3%. The Australian 3-year government bond yield jumped by 10 basis points in response to yesterday's interest rate hike, but settled lower at around 4.3%. Markets are pricing in a 50% chance that the cash rate will be hiked by 25 basis points at the next meeting in March, with at least one more increase by the end of the year. Well, the US dollar index down slightly on the day, the Aussie dollar extending its post-RBA rally to 70.5 US cents before consolidating, carrying at 70.2 US cents. Oil prices have continued to climb after the US shot down an Iranian drone, while Brent futures up 1.5% to $67 a barrel. Gold and silver prices have rebounded sharply after a steep sell-off over the previous two sessions, with bullion rising more than 6%, its biggest daily increase since 2008, as bargain hunters bought in. Spot gold close to $4,950 an ounce. Silver up more than 7% to $85 an ounce. And Bitcoin is trading below 76,000 US dollars. Well, let's get across what we're seeing on Wall Street at the moment. Joining us is Anu Ganti, head of US Index Investment Strategy at S&P Dow Jones Indices. Anu, welcome back. Great to see you for the first time in 2026. So interesting what's going on Wall Street right now, of course, just in that session just gone. As I just mentioned, we saw that rotation out of tech into small caps. What are your observations about those moves at the moment?
Yes, you're exactly right. It's great to be here again, and it was a rough day in the market. We saw the pullback in tech, jitters throughout global markets. So what we're really seeing here is the start of a potential rotation, and we can think about it in a lot of different lenses, going from large to small caps, as you mentioned, going away from tech into other cyclical sectors, for example, value outpacing growth, momentum lagging in January. So this is the sentiment shift that we're starting to see. And of course, we're in the midst of earnings season, and all eyes are going to be on earnings. Of course, you mentioned Alphabet and Amazon coming up, but there's been a lot of idiosyncratic risk going on under the hood. So really interesting time to be examining, for example, various strategies when thinking about exposures. You talk about small caps. We have our S&P 500 equal weight index, which has a smaller cap bias. It actually outperformed by 2% in January. Very interesting, has a smaller cap bias, has a tilt away from momentum. And also coming back to sectors, if you think back to last year, there were only three sectors that outpaced the S&P 500, and now come January, that broadened to seven. So the broadening of the rally is really interesting to watch right now.
I see you point out that the weight of the top 10 companies in the S&P 500 is slipping below 40%. So we're seeing essentially that diluted.
Yes, no, it's an excellent point to be looking at market concentration. And we've started to see that dip come most recently in November. And if you look at history, of course, no one knows what's going to happen in the future, right? But historically, we've seen that after peaks in market concentration, that equal weight has tended to outperform cap weight. We've also seen these inversions between momentum and equal weight. And after the pullback historically in momentum, we've seen that equal weight has outperformed. So the question is whether that reduction in concentration will stick, whether the broadening of the rally will stick, and of course, how earnings are going to play out through the rest of big tech this week. And coming back to your opening segment, of course, there's a lot of geopolitical uncertainty, trade-related tensions. Rates are key right now to watch. Of course, with the news of the potential new Fed chair. So rate sensitivity and thinking about rate sensitivity across sectors, and especially with metals. You talked about silver and gold earlier, and the strong volatility we've seen there. So sensitivity of sectors to oil, to the dollar, which has weakened so much, and to all these different macro factors will be really important in the coming days.
I know, I see, based on your research, you're saying 2026 is the year of the stock picker. What opportunities are you seeing, particularly for those active managers?
Yes, no, it's a question that we're all wondering, right? And if you look back to last year, we saw that 30% of stocks beat the S&P 500, a very relatively slim number compared to history, although it was higher than the past couple of years. Of course, 2023, 2024, 2025, we saw the mega cap strength, but 2025 was really interesting because if you think back to early April, and the tariff-related turmoil, there were pockets of opportunity for stock pickers to outperform. Another signal, and of course, I don't have my crystal ball, but I will tell you that we have a dispersion index called DSPX, and it uses options to measure the market's expectation of dispersion. We look at it closely because the greater that spread is, the greater the opportunity for stock pickers to add value. And that number has climbed upwards in January. So as we see more idiosyncratic risk, which is typical in earnings season, there might be greater opportunity potentially.
Now, Anu, I see you point out you're saying you don't have your crystal ball at the moment. That is fraught, isn't it, when you try and forecast what's ahead, particularly in such a volatile environment. Nonetheless, I mean, what are those challenges in forecasting the broader market at this point?
Yes, forecasting is extremely difficult, and we did a fun research piece on this where we looked at top-down forecasts historically, and we saw that they severely underestimated the level of the S&P 500, for example, in the past couple of years, when of course we saw extraordinary mega cap strength. We also looked at bottom-up forecasts, and they were also significantly wrong, particularly during the financial crisis, for example, and even longer term forecasts were worse as well. which is why we're really signaling caution that no one really knows what is going to happen. I think 2025 was a great example of that, with the market down to almost bear market territory, and the significant recovery that we saw since. So it was really a tale of two markets.
I know, great to get across what you were seeing in 2026. Thanks so much for joining us from S&P Dow Jones Indices.
Thank you.
Let's now turn our attention to the local markets, and we are expecting a lower start. So SPI futures off around 0.25%. That is off the back of that negative lead we got from global markets overnight, in particular Wall Street taking a tumble. So tech is going to be in focus locally, given the sharp sell-off we saw on Wall Street. Gold also will be in focus, given we've seen that sharp rebound in the price of bullion. And of course, we'll be getting more reaction to that interest rate hike from the RBA yesterday. Stay with us for the open.